Hello and welcome to the Business Standards Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day.
What the world needs now is people who see energy a little bit differently. Because seeing a more sustainable world isn't far in the future. We're building it now. GE, building a world that works.
A college dropout Gautam Adani reached Mumbai in 1978 to chart out his own course away from his father's small textile business in Ahmedabad. From a diamond sorter to the world's sixth richest man, the last 44 years saw him growing from an ambitious teenager to an astute businessman. And the last 2 years have been quite eventful when his wealth grew from $8.9 billion to $106 billion. A figure, when put on graph, throws almost a 90-degree bend. He has been on a shopping spree for a while now. Last week, he clinched a deal to acquire Ambuja and ACC Cements. Our next report offers a peek into his growth over the years.
In one fell swoop, Indian infrastructure conglomerate Adani Group is set to become the country's #2 cement maker with the $10.5 billion acquisition of Ambuja Cement and ACC from Switzerland-based Holcim. With 70 million tons per annum capacity, Adani is firmly above the number 3 player, Shree Cement, which has a production capacity of 43 MTPA. This would be the group's biggest acquisition to date, highlighting its aggressive inorganic growth strategy. The Adani Group is led by 59-year-old first-generation entrepreneur Gautam Adani, who is now Asia's richest and the world's 6th richest person with a fortune of nearly $106 billion, according to Forbes. He even briefly surpassed investment maverick Warren Buffett in the global wealth rankings recently. Dominating practically every other sector it is engaged in has been the hallmark of the Adani Group, the latest being cement. The group was born in 1988 when Gautam Adani, who had dropped out of college, set up the flagship company Adani Enterprises to import and export commodities. Listed in 1994, Adani Enterprises became India's biggest coal trader and the biggest coal mining contractor. It also acts as an incubator for the group's new businesses. Soon after the economic liberalization, Adani won the mandate to set up Mundra Port in Gujarat in 1995. And in 1998, Adani Ports and Special Economic Zone was set up. Mundra has become India's largest commercial port by volume, while APSEZ is India's biggest private port operator, with 13 ports and terminals handling near 1/4 of the cargo movement in the country. In 1999, Adani Wilmar was incorporated as a joint venture between the group and Singapore's Wilmar. Known for its Fortune brand, the company went on to become the largest edible oils brand and importer in India. With a revenue of 54,214 crore rupees in FY22, Adani Wilmar trounced Hindustan Unilever as the country's biggest FMCG company. The group entered the city gas distribution business in 2001, and in 2005 it won India's first mine developer and operator or MDO contract. Adani Ports and SEZ was listed on the exchanges in 2007. The following year, the group made its first overseas purchase by acquiring the Banyu coal mine in Indonesia. In 2009, Adani Power made its debut on the bourses. It is the largest private thermal power producer in India now. In 2010, the group acquired the controversial Carmichael coal mine in Australia. The mine has faced severe opposition from environmental groups. The first export shipment from the mine took place in December 2021. Adani Transmission, the largest private sector transmission and distribution company in India, was demerged and listed in 2015. In 2017, the group forayed into manufacturing of solar PV panels. Adani Solar is today India's largest integrated solar cell and module manufacturer. Adani Gas and Adani Green Energy were demerged and listed in 2018. The same year, Adani Transmission acquired Reliance Infrastructure's Mumbai energy distribution business. In 2019, French energy major Total Energies bought a 37% stake in Adani Gas. Renamed into Adani Total Gas, the company operates the largest city gas distribution business in India. Adani Green Energy is among India's biggest renewable power companies and also the group's most valuable company with a market cap of $45 billion. In 2020, the group forayed into airports business after winning the bid to operate 6 Airports Authority of India airports. It also acquired the Krishnapatnam port, which is India's second largest private port. Last year, it took over Mumbai International Airport and Navi Mumbai International Airport from GVK Group. This made it India's biggest private airport operator, accounting for more than a quarter of the country's airport footfalls.
Adani Group has become one of the fastest growing mega groups in India. Whether one questions the tactics adopted for achieving this growth, or the corporate governance quality, or the connects in the right places, whether as an analyst you like it or not, you surely can't ignore this group. Debt has been an issue with this group and continues to be so, with the leveraged or structured M&A transactions they're getting into. But today they have become large enough to be termed too big to fail. So basically it's not a group's problem anymore, it's the country's problem if anything were to go wrong. For the time being, it seems they have the Midas touch and the group stocks are a trader's delight. It's anybody's guess as to which would be the next big sector on the radar. Financial services, media, airlines, hospitality, never know. There will always be some synergies.
The conglomerate has been moving beyond its core business of operating ports, power plants, coal mines, and renewable energy. It is now venturing into areas like data centers, financial services, airports, digital services, real estate, and media. The group's expansion has been fueled by debt since it bets on capital-intensive sectors. The 7 publicly traded companies of the Adani Group have a combined market capitalization of $184 billion, and that is only set to grow with the acquisition of Holcim's India business. But the combined gross debt of Adani Group companies increased to a new high of 2.09 trillion rupees at the end of March this year, up 35.2% from 1.55 trillion rupees a year ago.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Shares of ACC and Ambuja Cement soared up to 4% in yesterday's trade after the deal. Analysts now believe the Adani Group may merge both these entities over the medium term. Watch our next report to know more.
At $10.5 billion, Adani Group's buyout of Holcim India's stake in Ambuja Cements and ACC marks India's most expensive deal in the sector. With this, the group has also leaped to second position in the cement industry, coming only after Ultratech Cement. While Holcim owns 63.19% stake in Ambuja Cements and 4.48% in ACC, Ambuja Cement in turn owns 50.05% in ACC. The Adani family plans to make an open buy offer to buy 26% stake in these two companies from non-promoter shareholders, subject to regulatory approvals. Once approved, Adani Group will enjoy Ambuja and ACC's combined capacity strength of 67.5 metric ton. Going forward, analysts believe that Adani Group may consider the merger of Ambuja Cement and ACC in the medium term, as it will help them rationalize fixed cost quotients at both these entities. Market analyst Jijo Kalingam, for instance, believes that the acquisition would trigger re-rating of ACC and Ambuja Cements, as businesses may merge under one entity.
Both of them will get re-rated because ultimately both have to be merged, So, that's my view. It doesn't make sense, same individual or institution owning same business under two companies. So, theoretically speaking, they can be merged. So therefore what I applies to one can apply to other. C re-rating because Adani Group companies all have a very high PE in the market, even after the severe correction. So this might give some hope for the investors to bank on Adani stocks, Adani's new stocks.
Those at Kotak Institutional Equities too believe that the EBITDA per ton for Ambuja and ACC is lower than Ultratech Cement, and this gap can be covered by Adani through synergy benefit from eventual merger of the two companies. The benefits, it says, may include saving from existing royalty payment to Holcim, investments in cost-saving projects, and margin expansion opportunity through brownfield capacity expansion. That said, some analysts believe Adani may go for brand consolidation rather than outright merger.
Both the ACC and Ambuja, they have been losing market shares over last few years. With the Adani coming into the deal, so there will be more aggression in expansion since both Ambuja and ACC are expanding their current capacities, and they are expected to reach 100 million ton of capacities combinedly by FY 24-25. This will be good for the cement sector as we see large players getting more consolidated, and there may be more consolidation happening in the industry moving ahead also. There may be brand consolidation. I cannot say on merger because how Adani will structure the deal and how they will address the market. But brand consolidation will definitely may happen over the period of time because currently both Ambuja has its own brand and ACC has its own brand, and they are market brand in Indian cement industry.
That said, analysts see limited near-term synergies from the deal.
Utilization levels in both Ambuja and ACC are pretty high. So it's not that Adani coming in will immediately change anything in terms of output or the efficiency levels. Though Adani Group is backward integrated, so there might be some this is synergy gains over a period of time. Number three is it will also depend if Adani Group will go ahead to some aggressive expansion after the acquisition. That could create some pressure in the industry.
Overall, from an investment viewpoint, analysts expect ACC to see higher re-rating as the stock has traditionally been an affordable bet. At the bourses, ACC closed nearly 4% higher at 2,195 rupees per share, while Ambuja Cements rose 2.6% to 368 rupees per share on the BSE on Monday. In comparison, the benchmark indices closed 0.3% up. As regards Tuesday, markets will track the listing of insurance behemoth Life Insurance Corporation of India. Shares of LIC were trading at a discount of 15 to 20 rupees a piece over its issue price of 949 rupees in the grey market on Monday, suggesting a weak listing today.
यार मत पूछ यार, फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर। इसमें बहुत तामझाम है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
From Adani's acquisition spree, let us turn our focus to companies which are caught between rising attrition rate and their plan to bring all employees back to office. Scores of employees of edtech firm White Hat Jr. have reportedly quit over the last 2 months after being told to join offices. It has brought the focus back on India Inc.'s return to office plan and challenges it is facing in implementing it. So what the road ahead looks like and what are the possible solutions that India Inc. can deploy? Let's find out.
The COVID-19 disruption has changed the way we live and work. While companies had to fast forward digital transformation, their workforce adapted to remote and hybrid operations to ensure work continuity. As economic activities are returning to normalcy, India Inc. is now facing pushbacks in getting its workforce back to the office. However, a mass resignation reported at Mumbai-based startup White Hat Junior after it asked its employees to get back to office has put the spotlight on the problem facing India Inc. Employees don't want to return to office full-time. According to a November 2021 survey by NASSCOM and job portal Indeed, around 70% of IT companies were trying to make the hybrid model work effectively. The survey found that 66% of the respondents had reported higher employee satisfaction working remotely. Now let's examine the present employee outlook and the steps taken by India Inc. In March 2022, a Financial Daily reported the findings of a survey where 6 out of every 10 employees who responded were prepared to quit their jobs instead of returning to the office. The same survey by recruitment firm CIEL HR Services found that a similar number of employees were ready to forego a higher paying job that required them to come to the office. This view is prevalent among employees in sectors like IT, outsourcing, consulting, and BFSI, along with tech startups. According to a recent Business Standard report, companies across sectors are proceeding cautiously. In June 2020, FMCG player Kavin Care had said that it would rent out its corporate office and its 300 plus employees might work from home permanently. At present, Kavin Care's corporate office is still in the work from home mode and in-person meetings are held once in 15 days. In April 2020, TCS called out for a 25-25 model. Under this model, by 2025, 25% of the IT major's workforce would work out of its facilities without spending more than 25% of their time in office. HCL Technologies, meanwhile, has identified 40 to 50% of employees who can work from home permanently. For its part, Upgrad has established offices across multiple locations in multiple cities. This has allowed its workforce to choose their preferred work location. Over at ITC, employees can work from home for up to 2 days in a week. However, this is subject to approval, and in case of an emergency situation, work from home is allowed for up to 15 days in a month. For many who have moved back to their hometowns, it will be difficult to convince them to return to the high rents and long office commutes of the metros. Some prefer continuing from their hometown. Hybrid work models might not be enough to retain such talent. However, there are other options.
And there is also a possibility that if many of their employees, as you said, depending upon sector, functions, or locations, are going to work remotely, some of the offices will move away from the big cities and can come up closer to some of the hubs where the talent actually resides, right? So you might see that organization will reduce office space in a bigger location like Bangalore and have smaller office space in many of the middle or size cities, maybe in some parts of say Kerala or Tamil Nadu, or for that matter Nagpur in North. Having the talent and somebody whom you have worked with and somebody who has worked for so long and has been contributing while during lockdown also, and their contribution has something which has been recognized. Now replacing somebody like that will always become a challenge. So it's always good that company have solutions which are employee friendly, and I think this could be one of the ways what companies are looking at or should be looking for.
There are many advantages for India Inc. too in adapting to the changed circumstances. Not to mention, the changes seen in the nature of work, like the hybrid model, might not go away even if the pandemic does.
The benefit what offices are going to get or organizations are going to make, right? Because once you look, if you look at the pre-pandemic, the rental cost which was used to be associated, it is as good as that was hitting close to 20 to 30% depending on the office size and the location and where you have taken, right? And with this sort of model, there is definitely a cost which is being saved by the organization because of not being having such lavish office and at the bigger location. So I feel that in next 4 years, 5 years, while the pandemic might continue, I don't know how long, but there will always be a benefit which will not just be at the employee side, but the employer side also, which is in form of the rents and also maintaining a space like that. So it's I think both sides will be getting benefited while ensuring that you are getting the most out of people.
Getting employees back to work will be a continuing challenge, especially if COVID-19 cases rise again. Even if and when the pandemic ends, companies might find that they have to go to the employee location and not the other way around. What about you? Would you give up an attractive paycheck for work from home?
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है Investing made easy and reporting with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Most companies are treading cautiously while implementing the back to office plan. Meanwhile, the government and RBI are also circumspect as soaring inflation is hitting the common man hard. But what is CPI inflation and how is it calculated? Let's see.
In March this year, inflation in the US had peaked at 8.5%, the highest in the last 40 years, before scaling down a bit. Several other countries too are reeling under high inflation, and some of them, like Sri Lanka, are on the brink of an economic collapse. India too has not remained untouched. Led by rising food and energy prices, the country's retail inflation rate, as measured by the Consumer Price Index, jumped to a near 8-year high in April. According to data released by the Ministry of Statistics and Program Implementation, at 7.9%, the annual retail inflation was the highest in 95 months in April. The last time the inflation print was higher than this level was in May 2014, when the figure stood at 8.33%. CPI numbers were originally introduced to give a measure of changes in the living costs of workers so that their wages were in tune with the changing prices. However, over the years, it has been widely used as a macroeconomic indicator of inflation and also as a tool by the government and the central bank for targeting inflation and monitoring price stability. CPI is also used as a deflator in the national accounts. It is released at 5:30 p.m. on the 12th of every month for numbers relating to the previous month. Inflation is the measure of change in the average price of services and commodities done at regular intervals. It indicates a decrease in the purchasing power of a unit of a nation's currency as the products and services get more expensive. CPI is an indicator of inflation. It measures the percentage change in the price of a basket of goods and services consumed by households. Similarly, the wholesale price index measures changes at the wholesale price levels. To measure inflation, we estimate how much CPI has increased in terms of percentage change over the same period the previous year. If prices have fallen, it is known as deflation. Economists believe that low, stable and predictable inflation is good for an economy. India's central bank, the Reserve Bank of India, pays very close attention to CPI inflation in its role of maintaining price stability in the economy. The RBI has been mandated by the government to maintain retail inflation at 4% with a margin of 2% on either side, and the central bank is answerable to the policymakers if it misses its target for 3 consecutive quarters. The CPI is designed to measure the changes over time in the general level of retail prices of selected goods and services that households purchase for the purpose of consumption. Such changes affect the real purchasing power of consumers' income and their welfare. The CPI measures price changes by comparing through time the cost of a fixed basket of commodities. The basket is based on the expenditures of a target population in a certain reference period. The CPI basket has 6 broad groups with different weights ascribed to them. The food and beverages component in the CPI basket, combined for rural and urban, has the highest weightage at 45% 35.86%. The weight of clothing and footwear is 6.53%. Fuel and light is 6.84%. Housing is 10.07%. And pan, tobacco and intoxicants is 2.38%. Each group has categories, subgroups and sections. For example, the food and beverages group is made up of 2 categories. The food category has subgroups like cereals and products, meat and fish, egg, fruits, etc. In April, inflation in food and beverages rose to 8.1%, while fuel and light inflation reached the double-digit mark at 10.8%. Separately, the government also compiles the Consumer Food Price Index as the weighted average of subgroups like cereals, milk and products, spices, etc. Food inflation, as measured by the CFPI, rose to a 17-month high of 8.38% in April.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
To tame inflation, central banks raised short-term interest rates, making borrowing of money more expensive. That's all for today. We will be back with more news and analysis on our next episode. Stay tuned and thank you for watching. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.